By the end of March, the national average price of gas in the United States hit $4.02 a gallon, the first time it had crossed $4 in over 3 years. If you felt it at the pump, that number is exactly why. Here's the full story of how Q1 2026 got there. To understand how we got there, you need to know what everyone was saying going into this year. The mood was actually pretty optimistic. Inflation had finally come down. America's central bank, the Federal Reserve, was expected to cut interest rates 3 times in 2026. The stock market was riding an AI boom. Analysts were calling it a soft landing, the economy slowing down without actually crashing. For once, everyone agreed, the worst was behind us. And honestly, January played along. Stocks hit fresh records. Bitcoin briefly touched $95,000, a number that felt unthinkable just 2 years earlier. But beneath the headlines, something was already off. In the first 3 weeks of the year, Amazon quietly cut 16,000 jobs. Dell cut 11,000. Then in February, Block, the company that runs Cash App, let go 40% of its entire workforce. All before the month was out. Meanwhile, something was happening in the gold market that not many people noticed. Gold is what investors buy when they're nervous about everything else. On the 28th of January, gold hit a price it had never hit in all of recorded history, $5,589 an ounce. An all-time record. Gold doesn't do that when everything is fine. It was a warning. And it turned out to be a good one. In February, the crack spread into the stock market. Here's the strange part, investors weren't just worried about the economy. They were worried that the AI boom lifting other stocks was actually going to replace the very software they were selling. Adobe, Salesforce, ServiceNow, all started falling sharply. By mid-February, the whole sector was down more than 20%. The AI wave was eating its own. Then on the 20th of February, the Supreme Court did something almost nobody had seen coming. In a 6-3 decision, the justices ruled that the tariffs President Trump had placed on goods from China, Canada, Mexico, and dozens of other countries were, legally speaking, invalid. The law he had used, they said, never actually gave the president the power to set tariffs. Around $170 billion had already been collected from American importers, businesses that had been passing those costs on to consumers. For most people paying higher prices, that money was gone. But here's the thing, the tariffs didn't actually disappear. Within hours of the ruling, the president signed a new executive order using a completely different law. A flat 10% tariff on everything entering the country, from everywhere. The very next day, it went to 15%. Different legal paperwork. Same effect on your grocery bill. By the last week of February, markets were adjusting. Messy, but survivable. The soft landing story was bruised. Then the morning of February 28 arrived, and the whole quarter changed direction. In a 12-hour operation, American and Israeli forces launched hundreds of strikes inside Iran. Nuclear facilities, missile bases, command and control infrastructure, all destroyed. Iran's supreme leader was killed. For years, the world had been watching the Middle East and saying, this could escalate at any moment. On February 28, it did. Iran's response wasn't military. It was geographical. 20% of all the oil shipped on the planet, every single day, passes through one narrow channel in the Persian Gulf. At its tightest point, it is 21 miles wide. It's called the Strait of Hormuz. And on the 2nd of March, Iran announced it was closed. What followed was the largest oil supply disruption in modern history. Within days, more than 20 tankers had been attacked or seized. Saudi Arabia, Iraq, and Qatar, the 3 largest oil exporters in the region, couldn't move their ships out. By the end of March, more than 200 fully loaded oil tankers were sitting anchored in the Persian Gulf, with nowhere to go. And the price of oil did exactly what you would expect when a fifth of the world's supply suddenly disappears. In less than a month, Brent crude nearly doubled. Around $60 a barrel in early February, to close to $120 by the end of March. In Asia, it briefly hit a record $166. A move the oil market had simply never seen before. And you felt it every time you filled up your tank. The national average price of gas in America crossed $4 a gallon for the first time in over 3 years. That's the average across all 50 states. California was already above $5.40, while Mississippi was still under $3.70. But everywhere in the country, the number was moving in the same direction. The Federal Reserve had started the year with a plan: cut interest rates 3 times. Those cuts were supposed to bring down mortgage rates, car loans, credit card debt, make borrowing cheaper for ordinary people. On the 18th of March, that plan was shelved. The Fed froze. New projections showed just one rate cut for all of 2026. 7 of the 19 officials on the committee thought there should be no cuts at all. In London and Frankfurt, the same answer arrived the same week: hold. If you were waiting for financial relief, the message was clear: not this year. March was brutal on Wall Street. The S&P 500 fell 5%, its worst month in almost a year. Tesla missed its sales targets and dropped 20%. Software stocks were down nearly a third for the quarter. The AI wave was supposed to carry the market. Instead, it was leading the sell-off. Meanwhile, cryptocurrency did the opposite of what its backers had promised. Bitcoin lost nearly 24% of its value, its worst start to a year since 2018. Across the entire crypto market, hundreds of billions of dollars in value evaporated in 3 months. Gold went up. The dollar went up. The things people had been told were the new safe haven turned out not to be. And then a word surfaced on financial television that hadn't been used seriously in 40 years: stagflation. It means the economy stops growing while prices keep rising at the same time, the worst possible combination, because the tools you use to fight one make the other worse. You can't cut rates to rescue growth when inflation is already rising. The chief executive of JP Morgan Chase warned about it publicly. Goldman Sachs put the odds of a US recession at 30%. Moody's went as high as 49. On the final day of the quarter, Oracle, one of the world's largest technology companies, announced it was cutting as many as 30,000 jobs, redirecting that money toward artificial intelligence. By that point, roughly 80,000 technology workers had lost their jobs across the industry in the first 3 months of the year. On the 10th of April, just days ago, the official inflation figure for March was released. Prices in the United States had risen 3.3% over the past year, the highest reading since early 2024. The majority of that increase came from a single source: gasoline. The inflation that everyone had declared beaten, the one that made rate cuts feel possible, was back. On the 8th of April, a ceasefire was announced. The fighting stopped. But the Strait of Hormuz did not reopen. Iran began charging what is reportedly as much as $2 million per vessel in transit fees. As of this week, more than 200 fully loaded oil tankers remain anchored in the Persian Gulf, waiting for a price the world has not agreed to pay. The quarter that opened with talk of soft landings and rate cuts closed with 90 days of damage. More expensive petrol. More expensive food. More expensive borrowing. The forecasts that had promised the worst was behind us had to be rewritten, not over years, not over months, in real time, over 90 days. Quarter 1 2026 will be remembered as the quarter the global economy was rerouted by a 21-mile channel. Whether Quarter 2 sees the strait reopen or pushed further closed is the question every central bank, every energy company, and every household is now waiting to have answered.